Hello and welcome to Cleaver Fulton Rankin's second manufacturing webinar discussing supply chain risks, commercial contracts and funding options available to manufacturers during this period of crisis and as lockdown hopefully begins to ease. My name is Aaron Moore. I'm a director and head of the manufacturing team at Cleaver Fulton Rankin. Cleaver Fulton Rankin's multidisciplinary manufacturing team acts for a diverse range of clients within the manufacturing sector. We understand the issues and challenges faced, particularly at this time. Our team brings together lawyers from across all disciplines who work collaboratively to provide proactive solutions in areas including supply and distribution, commercial contracts, mergers and acquisitions, financial transactions, IP and technology, product liability, commercial real estate, immigration, employment, and others. Over the course of this webinar, I'll be chatting with two specialists in the team, Directors Hilary Griffith and Caroline McLaughlin. We may not get a chance to cover everything on the topic areas in this webinar, so please do get in touch for advice or further information on any specific areas your business may be facing. All of our contact details can be found at cleaverfultonrankin.co.uk/people. So let's get started with some introductions. Hilary, hello.
Hi, Aaron.
Hello. So Hilary is the head of our corporate and commercial team at Cleaver Fulton Rankin. Hilary has practiced law in Northern Ireland for 18 years and has been named as a leader in the field for corporate finance in Chambers UK Guide to the Legal Professional and a leading individual in the Legal 500. She has extensive experience in all types of corporate finance, transactional and commercial work. This includes mergers and acquisitions, private equity and venture capital investment, corporate government, reorganisations and restructurings, joint ventures and collaborations and commercial contracts. Hilary acts for a number of leading manufacturers in Northern Ireland, including clients such as Ulster Carpet Mills, Lakeland Dairies and Boyce Precision Engineering. I'm also joined by Caroline. Hello, Caroline.
Hi, Aaron.
So Caroline McLaughlin joined Cleaver Fulton Rankin in 2019 as a director leading the banking and finance team. Caroline is an experienced banking lawyer advising a wide range of lenders and corporate borrowers on the full spectrum of finance transactions, including bilateral and syndicated corporate finance, acquisition finance, real estate finance, asset-backed lending and invoice discounting facilities. Welcome both and thanks for joining me today. Hopefully this can be a little bit less formal now. So Hilary, I'm going to start by asking you a few questions just to kick off the conversation, if that's okay.
Sure, no problem.
So Hilary, as lockdown eases, what steps can manufacturing clients take to identify any risks inherent in their supply chain so that they can effectively mitigate that risk?
Thanks, Aaron. Well, obviously the current outbreak of COVID-19 has caused significant disruption to supply chains across the world. And we do know from previous experience that any failure in supply chains can have a dramatic impact on businesses, especially manufacturing businesses. Therefore, it is so important for clients to assess early the potential weaknesses in their supply chain and to put in place appropriate planning strategies to mitigate those weaknesses. One of the first things to do is to identify which suppliers are most important to the business and what the impact might be if they were to suffer an insolvency event or were unable to get their supplies across borders due to certain restrictions in certain territories. Issues to consider is how easily those suppliers can be replaced or even partially replaced, whether to pre-order additional stock or any other contingency plans that you might put in place in the interim to secure supply. It is now more critical than ever to keep communication lines open with your supplier, and regular updates and reporting mechanisms will become completely critical. The earlier you become aware of an issue, obviously the more options you may have in dealing with that issue. So strong communication channels has never been more important. Look at the terms of your contract. I mean, hopefully you do have written terms, and everyone focuses obviously a minute around potentially around termination provisions. But there are a number of terms in your contract that will be very important to consider. So those are issues around delay, delivery, passing of risk and title, set off, force majeure, and of course termination. If possible, now is a really good time to gather all your contracts together in one place, preferably the signed versions of those contracts, together with any supporting documentation or additional email chains, which together record all of the terms that were originally agreed between the parties. You will want to try and get some information about where your key suppliers stand financially. Now, your contract might contain provisions which allow you access to that type of information, for example, to management accounts or cash flow records. But if you don't, now would be a good time to ask for that information, because it can be invaluable in giving you an insight into the likelihood of your supplier coming into difficulties. One general point I would make overall is when you're collating your information, make sure you do that comprehensively. Ensure you keep really good records of your assessment of the situation and its impact. It will be important to document your rationale and decision-making process, to record any decisions you decide to take, and even more importantly, those decisions you may decide not to take. And finally, there are a number of things that you should look for which might indicate there are potential problems in your supply chain. Like any relationship, the first signs of difficulty would be a lack of or reduction of communication. So if your supplier goes quiet or seems reluctant to talk to you, that can be a sign of a problem. Delivery. Is your supplier continuing to deliver on time and in accordance with the terms and the timescales that you originally agreed? If not, this can be an indication of some deeper problems. Obviously, requests for changes to payment terms is another indication that there may be difficulties. Has your supplier requested accelerated payment, deposits, upfront prepayments, or reduced retentions? All of these things can indicate that they are tight for cash. Finally, it goes without saying, keep your ear to the ground, keep talking to other people in your sector and industry, no doubt you will be, but marketing intelligence has been shown to be the first indication that someone is going into trading difficulties.
So, I mean, really, Hilary, I suppose three big takeaways there from me in terms of listening to that is be proactive, act quickly, and get as much information as possible.
Yeah.
Caroline, I'm going to move on to you now quickly here. Given the supply chain issues, what risks should businesses in the manufacturing sector be looking at under their existing financing arrangements?
Thanks, Aaron. Yes, I think there's plenty of practical steps that borrowers can be taking in the short term, many of which I'm sure companies are already thinking about. And we would recommend that companies review their existing facilities or loan agreements and prepare now. You should be checking for clauses that you may already be breaching, or clauses that you may be potentially likely to breach in the coming months. Examples of these would include your ability to comply with financial covenants. Are there any grace periods available to you, or any cure rights there? What impact on covenant ratios might the incurrence of any additional debt have? Do you need to be requesting any adjustments or covenant relaxations at the minute? Secondly, I suppose companies may find it difficult to continue to give repeating representations and warranties for all to remain true and accurate. In practical terms, particularly in the manufacturing sector, we can see that many businesses are drawing down all available credit lines to them, particularly on revolving credit facilities, which are common in the manufacturing sector. And you should be considering whether the reps and warranties are repeated at the date of each drawdown. Also, I think if you're looking at the events of default, which is probably one of the most obvious ones, things like commencing negotiations with creditors on debts, any full cessation of business, complying with information requirements and insolvency tests. And then there's the material adverse change, or MAC provision, which is really an option of last resort for lenders, but it is there as a catch-all and is really designed to cover risks that can't be anticipated, which is very much where we're at the minute. It's not something I'm really seeing lenders using in the market in any way at the moment, but I think it's something to keep an eye on in the future. Borrowers could also be considering any restrictions in their existing facilities on additional debt and indebtedness. Does taking any government scheme loans impact this, and particularly relevant probably for any any borrowers which are multi-bank funded. Hilary has focused on the supply chain risks, and I think particularly relevant to this is the invoice discounting and asset-backed lending, or ABL facilities, which are also very common in the manufacturing sector. This is definitely a time, I would say, where debtors are inevitably looking to stretch their credit terms. And you may also have a risk that many debtors may claim a contractual right to non-payment, like force majeure, which leads to a protracted recovery process. On a practical level also, I think that borrowers can be considering whether businesses can undertake site debtor audits, stock takes and valuations in line with any reporting requirements they have.
Thanks, Caroline. So to lead on from that, really, what is your recommendation to businesses looking at the issues that you've raised?
Generally, I think we're seeing lenders in the market being very supportive. Early engagement is always recommended, and I'm sure that's what many businesses are doing at the minute. Be proactive, have your frank discussions early with your lender around what is likely to be needed to ride out this crisis. Request in good time any necessary waivers, amendments, or deadline extensions you think you might need. I suppose this is particularly relevant for the more complex financings with club facilities or syndicated lending, where those requests could take longer to be granted. Obviously, take professional advice as needed. It's fairly obvious that there's active pressure on lenders from government to support viable businesses at the minute, and businesses may be looking, for example, at things like capital repayment holidays and both term and asset finance agreements. Lenders might be less keen on interest roll-ups or interest deferral payments, but these can certainly be discussed. And as I've mentioned, businesses can look to draw down all available headroom that they have in existing facilities, although do bear in mind that this isn't a necessity, as this isn't a lender liquidity crisis like we saw 12 years ago.
Okay, I mean, I suppose a takeaway point from me, and it comes back to some of the things that Hilary was talking about as well, is communication is going to be key in respect of this. It's probably communicate early as well as be proactive early in terms of the options that are available there. So thanks for that, Caroline. I'll be back to you in a minute. Hilary, sweeping back to you then. For manufacturing clients considering their next steps, what commercial or contractual strategies should be considered to maintain supply and avoid potential increased costs and customer delays?
Okay, well, obviously, when clients have gathered together the type of information and conducted the assessment that I talked through previously, Aaron, they obviously are going to have to decide how to use that information and what strategies or avenues might be available to them contractually or otherwise. So I suppose, and again, everyone tends to go straight to termination provisions, but there are a number of other aspects of the contract or the contractual arrangement that you need to think about. Firstly, probably is looking at the service levels that the supplier has committed to, or they can be called KPIs, key performance indicators, and really analyse the supplier's performance against those KPIs. Obviously, if a supplier is struggling to meet the KPIs on an ongoing basis, or there is a noticeable drop in service delivery, this is a strong indication that they're running into difficulties. So I think you probably need to look at the KPIs and consider whether you actually need to be reviewing them on a more regular basis, or indeed whether they're still appropriate for the contract as it stands now, or whether you need to start negotiations to amend those KPIs. But keeping a very close eye on that will be a first indication of a problem. Consider financial planning. For key suppliers, there are additional measures you probably should consider incorporating into your contract, because we tend to have standard termination provisions for insolvency events that we would draft in the normal way. However, at this stage, by the time the supplier becomes insolvent, it's probably too late. So you can put in place some form of contractual mechanism by which they're obliged to notify you of certain changes in their business, or if certain events occur which tend to predate an insolvency event. And these terms can be a very effective way of giving you early notice of a problem, and also can ensure that you're part of the conversation around recovery plans and you're not left in the dark. It also has been shown that when you have these types of conversation and you have this type of financial planning, you are more likely to avoid the problem and go to the sort of doomsday scenario, which puts you in a stronger position and can actually solidify your relationship with the supplier because you've helped them through what has been a very critical period. Funding. You probably need to look at both the supplier's funding but also your own funding, and to consider whether you need to accelerate your funding terms or amend those or change those. Maybe in some circumstances you would provide additional funding to suppliers, although that needs to be commercially considered very carefully. Actually, one option for some manufacturers will be to consider actually acquiring the supplier, where the supplier is so critical to their supply chain that in order to secure supply, it would make sense for them commercially to actually make an acquisition of that supplier. So it's important just to consider all the avenues open to you in that regard. Rights of set-off. I mean, obviously, the contractual right of set-off, essentially your ability to withhold money that is otherwise due to the supplier because they are otherwise in breach of the contract in some other area. You will need to carefully look at set-off provisions. You obviously do not want to be putting good money after bad. So if a supplier owes you significant amounts of money or is not delivering, etc., you will want to look at the set-off provisions carefully and see what way you can use those to your advantage. Step-in rights. The documentation may contain step-in rights. It's not very usual, but it depends on what has been negotiated in the first place. If you have step-in rights, this effectively lets you, in certain circumstances, step in and take over control of the contract. Or you can alternatively appoint an alternative supplier to take over performance in circumstances where your supplier is continually failing to meet its obligations. Recovery of assets. You need to look carefully at whether you have supplied assets, tools, or assets under license to your supplier previously. They may have some of your stock or your materials on site, and you will need to look at the provisions of the contract to see what ability you have to recover assets should you need to. And then finally, I suppose, is the suspension or termination of the contract. And we've talked about force majeure clauses, without getting too technical. There is no common law right of force majeure in this jurisdiction. So it's whatever provisions are in your contract is what will apply. So you need to look carefully at the force majeure clause, which actually people have tended to view up to now as a boilerplate clause and may not have paid that much attention to. So now it's time to look at it more carefully and see. Obviously, it may give the supplier the ability to suspend the contract, and you'll want to know how long they would have the ability to suspend the contract for. Does it cover this type of situation? Because that can have a dramatic impact on your business in the interim. And then I suppose finally, and this in many cases will be the last resort, but unfortunately in some cases will be the commercially the right thing to do, and that is to look at the termination provisions in the contract. And again, those are usually very quite often bespoke and particular to that contract. So you will need to get advice on that and get advice on that early as to what termination provisions you're going to invoke, and make sure that you comply with the notice and other provisions around that termination to make sure it is effective if ultimately you decide that's what you have to do.
Okay, I suppose, Hilary, the key takeaway point there for me is that many people will immediately think termination in this type of scenario, but by the sounds of things, there's a number of other contractual avenues and strategies that might be available, and that perhaps they should be considered first. So thanks for that. I certainly found that useful, and I imagine that many more people will as well. Caroline, I'm going to jump back to you now with a final couple of wrap-up questions, if that's okay.
Absolutely.
So Caroline, what are the additional funding options now available for businesses in the manufacturing sector?
So what I would say is there is a lot of funding options available at the minute. Most businesses will have some awareness to a high degree of awareness of what those are. If you haven't already and are considering applying for one of the government support schemes, I would recommend looking at these now, as the number of requests are high and this is creating some delays. A lot of the key details of the government schemes and the packages available are set out on our website on the COVID-19 webpage. So I'm going to take a fairly high level run through what the key features of the main schemes which would be relevant to the manufacturing sector are. I think firstly, there's the Coronavirus Business Interruption Loan Scheme, known as CBILS, particularly relevant to the SME market. This scheme provides for maximum support loans of up to 5 million for a maximum term of 6 years. It includes term facilities, overdrafts, invoice finance, and asset facilities. It's available to UK-based SMEs with an annual turnover of up to 45 million. And the loans are 80% government-backed. Interest and costs are covered for the first year. The scheme is available through accredited lenders and is delivered through the British Business Bank. From what we are seeing, I would recommend that your first port of call is your existing lender, as due to the demand, banks are tending to focus at the minute on existing customers initially. Then there's the Coronavirus Large Business Interruption Loan Scheme, which is known as syllables. Due to the large gap which had been created, the SME scheme was then extended out to large corporates with a turnover of more than 45 million per annum. This scheme can provide loans of up to 25 million to businesses with a turnover of between 45 to 250 million. And there's also the availability of a 50 million facility for businesses with turnover in excess of 250 million per annum. Maximum term under this facility is 3 years. And again, finance is available in the form of term loans, revolving credit facilities, asset finance, and invoice finance. Like the SME scheme, it's 80% government backed. However, critically, it does not cover interest and fees during your first year. For both schemes, you need to be able to demonstrate that the business was viable and that the loans would enable you to trade out of the cash flow difficulties arising as a result of the COVID-19 pandemic. Next, there's the CCFF, or the Coronavirus Corporate Financing Facility for large businesses, and it's operated through the Bank of England. This scheme is mainly for businesses with an investment grade rating, or which can be provided with an indicative rating, which applies to less firms in Northern Ireland. It provides funding through the purchase of commercial paper with up to a 1 year maturity. This scheme will operate for at least 12 months. Next, there's the Bounce Back Loan Scheme, which was launched on Monday of this week. It's aimed at small businesses, and no doubt there will be a big uptake for this scheme. It's providing loans of up to a maximum of £50,000, and these are 100% government backed, with no repayments due during the first 12 months. They run up to a 6 year term, and there's no early repayment charge. And the process has been fairly well streamlined, with the aim of providing a quick turnaround and access to funds. Next is the Coronavirus Future Fund, which is a scheme issuing convertible loans and applies to businesses with private equity investment. You can get loans between 125,000 up to 5 million, subject to at least equal funding from private equity. The business must have raised during the last 5 years at least 250,000 in equity investment to be eligible, and this scheme is expected to launch during May. There are many other financial incentives out there to assist businesses with cash flow at the minute, such as the HMRC time to pay service, deferral of VAT payments due between March and June 2020, business rates relief, the job retention scheme, and finally there are also business grants available in Northern Ireland, which for the manufacturing sector are probably really limited at the moment to the £10,000 grant for rental properties and the £10,000 small business grant.
Thanks, Caroline. There certainly seems to be a number of options and grants open to manufacturing businesses, which I suppose leads me nicely on to my last question, which is there anything that you're seeing in the market which businesses should be aware of when they're making applications under the loan schemes or grant schemes?
Yes, I think that Businesses should be bearing in mind that that an applicant under the loan scheme does need to be able to demonstrate the viability of the business, which I had mentioned, and businesses would need to have all their financial information and cash flow forecasts available to make the application. Also bearing in mind that lenders still need to follow to some extent their internal documentation process, although as most people will have seen, there's been significant pressure, which is fairly visible in the news, on government to speed up access to the funds under these loan schemes. And we're seeing those start to tick through quicker now than had been the case probably before Easter. Also bearing in mind that while some of the loans are covered to varying degrees by guarantee, it is worth remembering that the bank is the party which is guaranteed in these and not the borrower, and that banks will likely, should there be any default in future, be seeking recourse under the facilities which are there, and the guarantee would be used as a backstop. Lenders, as mentioned earlier, are being very supportive and are far better placed to deal with this shock to the system than they were in 2008. There's also the advantage of having numerous non-bank alternative lenders in the market, which also weren't there back in 2008. So businesses should be looking at private equity options. I suppose my last point would be proactive, have the frank discussions, and seek out all your options.
Thanks very much for that, Caroline, and thanks very much for that, Hilary, as well. I think that really allows us to conclude the webinar with a plethora of information, again, to our manufacturing clients. To conclude, on behalf of Cleaver Fulton Rankin, I'd like to thank everyone for watching us today. I hope you find the information delivered useful and that the questions addressed by Hilary and Caroline were useful and insightful. If you require any further advice or assistance on anything covered today, or indeed anything further, please do email me at a.moore@cfrlaw.co.uk. Or alternatively, you can contact Hilary and Caroline directly by the email addresses found at cleaverfultonrankin.co.uk/people. To keep up to date with our latest legal information or our thoughts on the latest government decisions or initiatives, please do visit cleaverfultonrankin.co.uk, or you can follow us on Twitter at Cleaver Fulton Rankin Solicitors on LinkedIn, our Twitter account is at CFR_law. Thanks again, and we hope to see you all again in the near future.